Welcome, everyone. My name is Laura. I'm from End Credit Union, and we're here today to talk about credit and everything that involves credit. So we're going to go ahead and get started because we have a lot crammed in here. But again, my name is Laura. I'm our community educator at End Credit Union. I do have a background in finance as well as education. So I love kind of helping the community with these financial education webinars. And again, we're going to be talking about credit. So let's dive into everything credit. So what I hope you take away today from today's session is the importance of credit. So why should you care about credit? How can it come into play for us? How we can use credit responsibly, as well as how is it broken down so we know the tools that they're utilizing so we can use it as our advantage going forward. So first things first, we kind of need to understand what a credit score is. So a credit score is really a complicated algorithm, but simply put, it's a number that lenders and service providers use to determine how likely a person is to honor their payment agreement. So financial institutions at the end of the day, they just want to know if they're going to get their money back that they loaned out, right? Or that they're going to get paid for those services that they're providing if it's a service provider. So credit can help financial institutions and others just kind of determine that risk level and potential risk when it comes to loaning or providing services to others. How it's done is through different bureaus kind of host our information. So they have all of our credit information kind of loaded up in there. There are the three major credit bureaus, so TransUnion, Equifax, and Experian. And through these, again, they are going to just kind of provide what credit we're utilizing, how much is owed, how much is left on a loan, if we're paying on time. And now, not everything is going to show up in all three of them. They used to be regionally done. So sometimes some folks still only report to Experian and not to Equifax or vice versa. And then others will, yes, report to all three. So it's important when you review them that you're checking all three credit bureaus. Now, this can cause some discrepancy in our credit score based on where they're pulling the information and if they're utilizing FICO or Vantage Score. So there are two different kind of scoring models out there. Again, FICO and Vantage Score. FICO is typically going to be utilized by lenders that are providing like a loan or a credit card, where Vantage Score is typically going to be for those Credit Karma, CreditWise type of consumer apps that are out there that help us get our credit score. Now, the range of the FICO score, I'm going to talk about the FICO scoring model because it is the most commonly used one for loans and credit cards. So the FICO scoring range goes from 300 all the way to 850 for the standard FICO range. Now, there are a few where it can go up to 900, like the FICO Auto Enhanced. So again, just there are some discrepancies. So instead of focusing on the exact number that you are falling in or getting, focus more on the range that you're given and utilize that to either increase your credit or see what's going on with your accounts. So you're not going to start right away in either poor or exceptional. You're going to kind of have like a 00 or 999 until you start utilizing credit. Now, 300 to 580 is considered poor credit. So in this, it'll be a few mistakes that are happening. You may not get approved for things. It might be a little bit harder. You might have to disclose more information or put more deposits down. And then once you're in the 580 to 670, you're in fair credit. Again, it still might be a little harder to get approved for loans or services, but you are making strides to get your credit up there. So 670 to 740 is considered good credit. You'll get approved for loans. It may just be middle market rates. You may not get the best interest that you can. until you reach that 740 or above. So 740 plus is considered A plus credit. And that's really what we're striving to maintain our credit at, is at that 740 plus area. So the real big difference between very good and exceptional is simply room for error. So if we're an exceptional, and if we miss a payment, we might fall to very good, but we're still in that A plus category range. So we're still going to get the best rates, get approved for loans, etc. But if we're in the very good and we make a mistake, we might fall out of the A plus range, and we may have to just work a little bit that much harder to get ourselves back into A plus category when it comes to our credit. Now, our credit score is broken into 5 categories, y'all. So the 5 categories that we have are payment history at 35% of our credit score, and then utilization or capacity at 30%. And then 15% is our length of credit, so how long we've had an account open. And then we have 10% mix of credit. So do we have a bunch of different types of credit out there? And then 10% new credit. Now, a lot of this we can control a lot when it comes to our payment history and our utilization, and that makes up a really good chunk of our credit score. So just knowing how they're working can really help us. So let's dive in a little deeper into what these mean and how we can utilize them to the fullest. So payment history, again, is 35% of our credit score. So it's the biggest chunk of our credit score. And it is making payments on time. Okay, can't stress that enough. Just make your payments on time and it'll boost our credit score or keep it where it's at. Now, late payments do have a great effect on our credit score. They can drop us quite a bit, and they're going to hang out with us for quite a while. So it's really important to make sure that we're not late. If you know you're going to be late, call the credit card company, call the loan officer, whoever you're late with that payment for, and see if there's any way that they can either extend it or have you do partial payment so it still counts as a payment, what have you. So just be in contact with whoever you're owing money to see if there's any type of leeway or resources for you. Now, for credit bureaus and our credit score, it's a late payment if it's 30 days past due. So 30 days completely past due is when it's considered a late payment. Now, our credit card companies will probably say it's a late payment if it's, a day after the due date is posted, and we may owe a fine for being late. But it's not going to hurt our credit score because we were only like a day late on our payment. But if we were 30 days past due, that's when it's going to really hurt our credit. Now, the type of payment also matters. So a loan is weighted a little bit heavier than a credit card, okay? So just kind of know that those installment loans are just weighted a bit heavier than credit cards are. So again, payment history, 35% of our credit score, making our payments on time. Whatever you can do to make sure you get those on time, do it. Now, the second biggest portion of our credit score is broken through capacity/utilization, and that's at 30% of our credit score. And this is only with revolving credit. So when I say revolving credit, that means personal lines of credit or credit cards. So it's however much we're utilizing in those. So our shopping habits, things like that, that's going to be what being impacted here on our credit score. So it's a balance that's being carried over each month. So at the end of the due date, it'll tell you, hey, you owe, $300 this month. And if you don't pay it, then that's the balance it's talking about, not the minimum balance, the full balance. Okay, so the less you carry, the better. So ideally, we want to stay under the 30% available credit mark. Okay, so if we have $1,000 credit line, we want to stay below $300 balance being carried over from month to month. Now, ideally, if we can pay it off in full every month and have no interest fees, and we're staying below that 30% threshold, so we're building our credit. Now, maxing out our credit line. So again, if we have that $1,000 credit line, so if we hit exactly at $1,000, it's going to be an immediate harm to our credit. Just saying, hey, this person maxed out their credit card. They may not know how to use credit responsibly. All right. So just know what your credit limit is and what your balance is. So that way you're never going to hit that max out line. So again, the less we carry over, the better for us. So 30% and below is what we're aiming for when it comes to our capacity and utilization. The next part of our credit score is broken out into length of credit. Length of credit is 15% of our credit. With this one, again, a long history of good credit raises our credit score. It shows, hey, we've been responsible with this line of credit for, X amount of years. We've been able to make payments on time, etc. So with this one, it's important to note that it's not just your overall length of credit, but each individual account age as well. So this one, just be careful when you are opening and closing a bunch of accounts that you are impacting this length of credit area. Now, the other one is a new credit. So new credit is 10% of our credit score, and it is essentially that. So opening up a bunch of new credit lines or opening up new accounts is what's going to be impacted in new credit. So it's going to have the biggest impact to our credit within this first 6 months of opening up those new accounts. But it will stay on our account as new credit for 2 years. So it's just something to be mindful of. So if you can space out your credit applications by 6 months, that'll really help you in this. Now, the difference between hard and soft hits are a hard hit is when we are actually doing an application. So we send in that credit card application or that loan application. That is a hard hit on our credit. It is an application for new credit. A soft hit is when an apartment complex or something is just taking a little tiny peek at your credit. They're not pulling the full credit report. They're not putting in a new application for you. So there is a difference between hard and soft hits. So if you are shopping around, maybe ask and see if there's a way that they can do soft hits rather than hard hits. So that way it has less of an impact on your credit score. Now, please do keep in mind this includes retail cards, like the Target Red Card, Best Buy account, etc. All right. Now, I do want to just mention again, back to the hard hits, you are absolutely okay to do rate shopping. So if you're out there getting a new car, so a new car loan, yeah, you shop around for that interest rate, right? You want to see what the best offer you can get. For FICO, it is recommended that you keep it between 14 to 45 days, ideally less than 30 days. So that way it only impacts your credit once. It's going to compact those into one hit rather than all those different types of hits to see what what the best interest rate is for you. Okay. So if you are rate shopping out there, just know for a little bit there, it'll look like a bunch of hard hits, but it will condense it down to one if it's within that short window of time. Now the final category is mix of credit. So mix of credit is just having different types of credit out there. So we have revolving credit, which I talked about is those credit cards and personal lines of credit. So with revolving credit, the amount owed each month is completely dependent on us and how much we're utilizing those credit cards or personal lines of credit. Installment loans are a regular payment that we have. We know how much we're paying for the balance, interest, principal, etc. for them. So it's a set amount that we agreed upon. So having a mixture of these two types of credit can boost your credit score. Mortgages also kind of do a nice little boost to your credit score just because they're a really big length of time when it comes to your how long you're paying off that credit card or your home, excuse me. So they do tend to have a nice little boost to our credit. Okay, so let's talk about how we can utilize this and how it can help us. So getting to know our credit cards, typically that's usually the thing that most of us think about when it comes to credit. So we want to make sure that we're paying our bills on time. So making sure, again, that we're keeping that payment history good, because it's 35% of our credit score. And then if we're paying it on time or early, so if we're paying it early, we're lessening that balance due, and it can impact how much utilization we're using. So if we know that we're using a credit card a lot, paying it early and more frequently might be able to help you lower that utilization down below that 30%. Again, keeping your credit score going up because you're less than 30% utilization on it. Now, if we do need to roll something over to the next month, we really want to know how much are we being charged for that. So that $100 purchase, if we let it roll over, on average, credit card interest rates are about 21 to 26%. So that $100 purchase is now $124 if our interest rate is 24%. So we really want to make sure we know that so we can make educated responses to our bills. And then it can be a free tool for us if we're picking a credit card with no annual fee and we're paying the balance off in full every month. Okay, it's a free tool for us to build credit in that regard, because most every loan will have interest. So a credit card is the only free way we can have us build credit if we're paying it off in full every month and there's no annual fee for it. And then knowing the difference between our billings cycle and our statement cycle, again, can really help us when it comes to that utilization piece, when it comes to our credit card. So just making sure we know when it's being reported to the credit bureau, how much we owe, how much we're utilizing on that card, can really help us know if we need to pay a little bit more frequently on that credit card. Now, again, to build our credit, using the right card for us. So, yeah, looking for one with no annual fee, or incentives that we actually utilize. And then budgeting, right? It goes back to that budgeting piece. So, avoiding charging more than you can pay off in full. So, if we're budgeting for our spending and we're not going over our limits, then we're going to be able to help build our credit because we're going to be able to pay it off in full every month, not incur that interest, and we're going to keep our utilization below that 30%. So we're going to be helping ourselves build credit. And then if we're not getting approved for credit cards or loans, then maybe looking into secured credit. So you can get a secured loan or a secured credit card where you're fronting the money for it. So you're taking the risk out of it from the lender's perspective because they now have the money in a deposit. So if you don't make those payments, then they already have the money sitting there. So it's a great way to build a payment history with somebody, and then after a while, they can convert it to a regular credit card. And then again, if I haven't stressed it enough, paying on time or early for us to build that payment history. So important for us. Now I'm going to leave you with some resources of how we can check our credit report and our credit score. So to check our reports, we can go to annualcreditreport.com. It's a government authorized way that we can pull our credit reports. What's nice about it too is it has all three credit bureaus right there. So you can just click on the one that you would like to pull. So because of COVID, they've expanded this. So we can actually pull our credit every week if we really wanted to right now. But it's a good rule of thumb to at least just pull it, once per each bureau throughout the year. So staggering it. So maybe one time in February and then June and then November, etc. So that way you're staggering it throughout the year and just checking to make sure that everything is being correct on those reports, that no identity theft is happening, that the balances that they're reporting are accurate, that there's no weird names on there or anything that shouldn't be. So definitely a good idea to at least pull it, once per year, but if you can, ideally more frequently than that. Again, we're just checking to make sure all the information that it is reporting is correct. It is not going to show us our score, so I will show you a way that we can pull our score so that way we actually know like what score and range we're falling in. So to do that, We utilize a company called Savvy Money. So if you go to ent.com/yourcredit, you can look this tool up. And on here, what's really nice is it has those 5 categories that I talked about, and it gives you a letter grade and personalized advice to help you build in that category. So if it's showing you that your utilization piece isn't so good, it'll give you good personalized advice on there, like, hey, this credit card right here, you're overutilizing, maybe pay more frequently or whatever. So it's really nice because it does give you a lot of that personalized advice on there. And it kind of just shows you again where your credit score is, your range, where you're falling, and kind of where you're comparing to other people at your age. So it's a really nice tool. So I'll just leave it up here. Um, I know I crammed a lot in today for our webinar on diving into credit. If you're curious about any of our other webinars, please go to ent.com/events and sign up. We have a few coming up. So always good to kind of keep your eye on that if you would like to continue your education. But thank you all so much today for joining me on this journey about credit and everything revolving around credit. So hope you took away one thing or more from this presentation. So thank you again. I appreciate it.